Good afternoon, everyone. It is Sunday, January 24th. 4th. In today's video, I want to go over a little bit of what happened during the COVID crash back in March of last year, and then the subsequent rally that is still going on. Now, obviously, that is not so relevant as far as trading it because it has already happened and it surprised a lot of people, I suspect. But I think that trying to figure out who did the selling and who did the buying in that period may be helpful in understanding how strong the hands who are currently holding all the stock that has been bought continue to be, and what may happen if we get another air pocket because of either the virus or the economy or whatever other reason. So those who have followed me on Twitter for a number of years and on See It Market know that I've subscribed to the thesis that the markets, equities have been going up since the end of the great financial crisis in 2009, mostly because companies bought back their own stock. And they, in essence, overwhelmed all other sellers. Now, this is not just a theory that I made up. It is something based on the flow of funds that are published quarterly in the Federal Reserve Z1 release. And if you care to dig into it more, it is table F223. I finally updated it. I hadn't done that exercise for the last couple of years, but I did update all the data to the latest release, which was in December of this year. And so if you look at it here, I understand that this chart is a little bit crowded, but hopefully if I point out the various bars, it becomes a little bit more clear. So from 2009, actually from 2007 through 2019, through March of last year, you can see that the major players in the market were household and hedge funds, which are marked by this light blue bar. Mutual funds and closed-end funds to a lesser degrees, and then companies, non-financial companies, buying back their own stock, which is this big maroon color line. The mutual funds and closed-end funds is the darker blue line that you can see here. So you can see that through the years, households and hedge funds were very heavy sellers here, and all through the decade, while the companies' buybacks were the overwhelming buyers, with some help from mutual funds and ETFs and through the years. But those were the two main players. And if you add all the numbers up, let me pull up the other chart. You continue to see that despite what happened last year, which was a complete change of character, buybacks still completely overwhelm all other buyers. So here you can see that since 2007, buybacks were a total, there were a net total of roughly $5.5 trillion of buybacks, which basically offset the other groups who bought and sold stock to each other, but in no great net amount. So the total net amount bought or sold by all participants except the companies themselves was $86 billion. And then against that, you had companies buying back $5.5 trillion of their own stock. So what changed last year when the COVID crisis hit was that the credit markets initially shut down and were very quickly reopened by the intervention of the Federal Reserve. And companies sold just an extraordinary amount of bonds to finance themselves through the crisis. But what they also did is that they shut down their buybacks, not only because they needed to preserve cash, but because it became something very unpopular from a political standpoint. So if we look at the data for 2020, and again, this is data from that the Federal Reserve compiles quarterly, and it's subject to some pretty heavy revisions, at least for 2 or 3 quarters. So what you see here is what is shown in the December release of the data, which annualizes what has happened up to that point. And you can see that there is just a sea change in the participants. All of a sudden, the household and hedge funds, these blue lines that had been selling for a decade, came back with a vengeance and bought roughly $900 billion worth of stock. Another participant, which had been basically absent, not really sellers or buyers, but basically absent, were foreign residents, foreign. I guess you can probably consider them funds for the most part. And they came in and bought another $750 billion. In the meantime, the people who freaked out, and predictably so, were the mutual funds, closed-end funds, and ETFs, which sold roughly $500 billion worth of stock. Who was conspicuously absent from the activity all of a sudden were the companies. So you see that here, these bars were in the many hundreds of billions of dollars every year. And all of a sudden, it looks like buybacks, net buybacks, so buybacks less secondary offerings and IPOs, are going to come out to maybe $25 billion. So the companies became irrelevant to the demand side for shares in the market. Now, you may wonder why this is relevant, and I'm not sure that it will be, or it will or it won't be. We'll find out. But one thing that I think is safe to say is that when companies buy back stock, they are very reticent to reissue it very quickly. They want to decrease their share count so that their earnings look better, their share prices, their valuations look better, and so on. So these are companies buying back their own stock. I guess you can consider them strong hands. In other words, that stock gets retired, and before it can be reissued, there are going to have to be some compelling circumstances to do that. Where instead, I think it is simple to see that household and hedge funds freaked out pretty quickly in the COVID crash, and they bailed. So a lot of the stock now has been transferred in the hands of households, U.S. households and hedge funds. Now, I would caution that these are probably 70-80% hedge funds and 20-30% households. Yes, we have had there's been a lot of headlines in the market about the retail speculators coming back in and so on. But mostly, when you're talking about buying in sizes of $1 trillion or just under that, these are institutional players. And the same goes for foreign residents. These are probably foreign funds, whether it be sovereign wealth funds or foreign speculators, who knows. The point is that these buyers are not as strong in terms of holding power as companies can be. So even though they can probably continue buying because many of them are momentum players, one has to wonder what happens when the music stops. Will these guys get out as fast as they've jumped in, or will they hold on and sort of tame any downside swoon? Now, the other thing to consider, of course, is that companies have piled all the cash that they have borrowed on their balance sheet, and to this point, I think it's worth looking at the issuance of new debt. This is again data that I have put together myself, and so there may be a few mistakes, but I've tried to be fairly careful. So here you see the rolling 4-quarter average of issuance of corporate bonds going back to 2000. And you can see the spike that occurred beginning in the first quarter of last year when companies rushed to the market after the COVID exploded and the Fed jumped into the market. So there has been just an incredible amount of quarterly issuance. The total for this year is well north of $2 trillion. And a lot of this money sits on companies' balance sheets. Yes, a lot of them are going to have to use it because their businesses are slow and they're going to be slow for many years. But should things turn around and these companies wanted to put that cash to work, it would probably, let me get this back. Oh, what happened here? Well, I've screwed up in terms of the rotation of the chart. Here we go. It's not crazy to imagine that buybacks could kick back in, and they could provide a cushion from any future air pocket in stocks. So again, this is backward-looking data, and I am not sure that it is tradable, but I think it may be very instructive as to how solid the ramp that we have seen can continue to be if and when the market runs into trouble. So that is it for now, and I will see you all soon. Thanks.